Good morning, Aishwarya. Also, I already laid out the picture. We've seen what cues that we are getting from overseas. Most of the markets, that negative stretch perhaps is going to continue for even the Indian equities. But if you have to look at the other headwinds that we're seeing, is it just commentary from the Fed, or is it actually going to be these bond yields that are really changing the equity game as well? Give us your take on that.
Good morning, Stacey, and good morning to all the viewers. Thank you for having me here. Obviously, yesterday's comment of the Fed chairman has created, I would say, the hardening of the yield across the yield curve. If you look at from as low as 1 week to a 30-year period, majority of those yields are either across 5 or closer to 5%. And obviously, it will have an ramification impact on the equities across the globe. That is what we have seen, that especially the European market, if you look at, they are at almost at a 7-month low on account of the slowdown in the growth as well as the rising yield across the curve. So obviously it has an impact on equity market. But what is really important for us to understand that it is just not the yield which is impacting the equity market. There are other factors at place also. So there is a fear about slowdown in developed market growth alongside China. And at the same time, we have all this geopolitical risk which is ongoing. So your hardening of yield curve, your geopolitical scenario, your the slowdown fear is all impacting the global equity market. But in this context of all of that, if you look at India's market, you will be surprised. You won't be surprised to see that India's is the best performing equity market in the last 6 months. And that's the reason for that, because if you look at the data, all the high frequency indicators, all the macro indicators of the Indian economy, right from GST, from PMI, from credit growth, the fiscal deficit side, inflation, majority of them are reporting a very, very, I would say, conducive environment for equity. And as you said, we are in the thick of this quarterly season, and so far, I think more than 100 odd companies, relevant companies have reported numbers with almost 12% kind of a year-on-year revenue growth and almost 20% kind of profit growth, providing a very important stimulus for this market to stay healthy. Obviously, we have seen a lot of IT companies reported numbers which were on a weaker side. If you look at the various other sectors, the business season has been pretty, sanguine from that perspective, which is giving the much needed support to the Indian market. But obviously, this geopolitical risk, which is hanging on all of us, if it escalates, we will not be surprised to see this, create much more havoc on equity market across the globe. Last but not the least, if you really look at, the two important data which I'm personally looking at to see whether this geopolitical risk will really go off the roof. One is the crude oil prices, and another is the yield curve. Obviously, we are seeing that in the last 1 month, both gold and crude prices has inched up because of this geopolitical risk. But we are not seeing any, I would say, drastic movement in that kind of scenario. We are not seeing crude going off. Even a 1 month or 1.5 month high from that perspective. If you are entering into more, I would say, a bigger issue from geopolitical risk, we won't be seeing US 10-year yield at the current situation. So we very watchful of this. I think none of this has been overplayed. This geopolitical risk is there, obviously, for sure. But some sort of investors, the smart money is not thinking on those lines, Stacey.
Right. Well, talking about inflation in the US, which, always has those kind of implications even here. But the inflation is something that even our FMCG companies are really have to keep an eye out for. And we saw a slew of FMCG earnings that came out yesterday from HUL to ITC. And all of them did show that there is some bit of recovery. We wouldn't say that they were, fantastic numbers. They have held steady, we could say, for the second quarter at least. And they've shown some bit of improvement in their volume growth as such in the lower single digits, if you have to call it out. If you have to look at how brokerages are viewing them, well, on ITC, Morgan Stanley has now put an overweight call for them, and they're giving it a target of about 493 per share. So there are a couple of segments within these FMCG that have really worked, be it agri or paper, that has not worked for ITC, whereas the cigarette business has always being that pushing the numbers for ITC. Whereas if you look at HUL, then HUL did see its food and beverage business, that one take a dip in its EBIT this time around. So let's look at the overall picture for the FMCG sector as a whole. Now that we do have inflation to be watching out for, we are definitely seeing it ease, and we are seeing that little bit of recovery even in the rural demand. So will that really play out, and is now a good time to be looking at FMCG stocks?
So, Stacey, after the debacle in IT, I think FMCG looks really nice comparatively, right? We saw the result of Nestle and HU, Hindustan Unilever alongside ITC. Couple of things which has come out very clearly is that, as you spoke about inflationary trends, that obviously the growth side we have not seen a very strong set of numbers. Obviously, ITC has given a decent set of numbers, even Nestle reported decent numbers, but due to rural side, we have seen HUL's volume growth were much lower. But what really excited us is the way how they have expanded the margin across all of these three companies. If we also look at the CPI inflation numbers, which came very recently, there's a very clear trend that the inflation level is getting moderating, and we will possibly see this margin expansion continue as long as this growth is also supported in the coming quarters. So to answer your question short, looking at the way market is positioned, and very, I would say that limited avenue of investing across, FMCG could be one of those safe haven for investors from current perspective, because we expect these companies to report anywhere between 12 to 18% kind of an EPS growth, supported by high gross margin expansions because of those moderation in inflation. And at the same time, the way market is positioned, it's much more, I would say, safer bet to invest into FMCG names. We don't expect very strong growth in the staples side over the next 2 to 3 quarters. If one has to look out for growth, one has to look out for the discretionary side. If you have seen a place like, say, shoes, or possibly travel, or even if you look at PVR format of when they reported their numbers yesterday. So this discretionary side is something where possibly we will see higher growth because of a strong festive season. But staples, because of the rural side, might continue to not see very strong growth in the coming quarters. But that will be more or less offset by the margin expansion which you will see in the FMCG space.
Right. So you're saying discretionary stocks, those are going to be the ones that play at least for this festive season and, going ahead. Let me also get your quick view on the pharma sector, because we've seen a couple of M&A activity in that whole space, and we have a couple of earnings that we are leading into. So your quick view on how one should be looking at the pharma sector right now.
I think pharma looks very attractive at the current juncture. The valuations of pharma are very, very, conducive from return perspective. And at the same time, the base effect of pricing in US look like to have been more or less done. And at the same time, when we are looking at the way US FDA is looking at approvals, we can clearly see the leniency coming out through. And as you spoke about, a lot of those acquisitions which are happening provides a lot of comfort from private equity sides and all of those players which have this confidence on pharma. And pharma has been a laggard for many, many years right now. So we are very positive on pharma, but we are very selective in that particular space. We still prefer pharma which has more exposure to India rather than US. And at the same time, we also prefer a lot of CT and API players right now, because we have seen that the kind of issues these companies had faced over the last 2.5 years are now on the back of the anvil, and we believe a lot of these companies will come out very strongly on numbers. We have heard a lot of these companies have signed good contract with various of these non-US kind of geographies, which will convert into higher revenues for them over the coming times. And also the stabilization of the commodity prices will help their margins in the coming quarters. When majority of these companies are trading at a very, very attractive valuation of close to 20 times to 25 to 30 times, which were earlier trading at almost 35 to 45 times. So we believe there is value proposition in pharma, in the API space, in the CDMO space, and even in large formulation player based out, which have high exposures to the Indian market.
Well, right. Aishwarya Didich, we'll leave it at that for now. Thanks so much for giving us your time this morning. But also, let's get some queries and answered from